Friends, welcome all of you. In your today's session, we are going to discuss again. We'll continue our discussion on the basic concepts of financial management. Our plan is to cover the unit one, first unit of your syllabus today itself. So let me share my screen. Let me first go through that whatever is taught to you. We'll recapitulate those things. Then some new concepts are there which we are going to learn. If you are looking at your syllabus, I'm finding we have to learn few new things like this thing, changing financial environment, emerging challenges faced by finance manager, and the functions of finance manager. All these three things we have not yet started. We are going to start that thing. So going to share my screen right now. Just have a look. Yeah. So for friends, what we have discussed, we have understood what is financial management. It is about managing money. That means you have to deal with collection, use, and return of money. This is the concept we have discussed. We have also seen different stages of business finance, how one decide an asset, how one determine the investment required, and how to decide what is the working capital requirement. Then decision about the source of this finance. These are the various stages of business finance, which we have already understood. Then we have understood various types of business decisions in our earlier sessions, like what is financing decision, what is investment decision, what is dividend decision. These concepts we have also understood. And we are also aware that these decisions are interlinked. They are not to be seen in isolation. And we had also discussed some of the basic techniques of decision making. So as you can see on the screen, some of the basic techniques are appearing here. Okay. So like payback period method, accounting rate of return method. Then you can see this undiscounted benefit cost ratio method, discounted benefit cost ratio method, net present value method, IRR method. These are the some of the methods. This is just the list of few methods. We'll be discussing about this later on. Functions of financial management, which are linked to the decisions like investment function, financing function, dividend function. Those aspects also we are discussing. We are also discussing that how balance sheet reflects various decisions of financial management. These aspects are also discussed. The concepts of uh, definition or there's few definitions of financial management. Also, we had discussed earlier, right? Scope of financial management. Also, we have completed our discussion. What are these financial decisions? That includes financing decision, investment decision, dividend decision, and all these decisions are required to be taken on the basis of risk and return. These concepts I had told you in your previous session. Therefore, one need to understand what is the risk and what is the return. And if you recall, our last session we have discussed the return means loosely you can talk return means some kind of profit or capital appreciation. That is what we talk as return. And when we try to understand what is this risk, I had explained you earlier. Risk means the fluctuations of return. Okay, fluctuations of the return is referred to as risk. Return means periodic return plus capital appreciation. For example, let us say you are buying a house. What is the return? If you are getting monthly rent, that is your return. But in addition to that, the value of house is also getting appreciated. Suppose you had purchased it at 40 lakh, it may become 50 lakh. That 10 lakh appreciation is also your return, right? So exactly same thing. Let us say you are investing money in a stock market. One thing is that you are getting dividend. But in addition to that, the value of stock is also increasing. So that is also your return. So this is what return is. And what is risk? Risk means the fluctuations of the return is referred to as risk. Okay, so in a previous session, I was showing you this particular table where as shown, let us say this, there are two projects, project A and project B. And project A, if it is giving return like this, 10, 10, 10, 10, 10, in the coming 5 years, let us say every year it will give 10 return. So total return will be 50 and average return will be 10. Whereas in project B, return may fluctuate. 1 year it may be 12, next year it may be 4, next year it may be 18, next year it may be 9, then 7. Even if total return is same, average return is 10. So I had asked you this question, that in which project you would prefer to make investment. So what was your answer? Can you tell me? Two projects, project A and B, in which project you would like to invest? Both the projects return, you see total return is same and average return is also same. Can you recall what was your answer? So at that time, you had replied that you would like to make investment in project A. And from that discussion, we have concluded that you are preferring project A because you feel the risk in project A is less and risk in project B is more. Why risk in project B is more? Because there are fluctuations in the expected return. Okay, this fluctuations is referred to as risk in branch investment. Okay, so risk is the variability of return. Risk refers to the possibility that actual outcome may be different from the expected outcome. What you are getting and what you are expecting, if they are different, you can say there is a risk. Suppose you are depositing money in the bank and you are expecting you're getting 6% return and you're getting 6%. There is no risk. Whereas if you're depositing the same money, let us say you're investing the same money in the stock market, you might be expecting 200%, you may get 2%. So that means there will be a difference between your expected outcome and the actual outcome. If that is so, that is referred to as risk. And how the risk is computed? There are various methods. Two popular methods is that we'll see the range of return. What is the highest return? What is the lowest return? If the range is wide, you can say risk is more. And other popular method is that you need to calculate the variance or standard deviation. We use both the things in statistics. So in statistical store, if you look at, these are the formula. So standard deviation, you see square root of variance. First you see variance is calculated like this. Sigma probability into deviation square. Standard deviation is the over of the variance. You'll be better understanding it with the help of this example. Let us say you are making an investment and the possible returns are like this: 6%, 12%, 20%, 24%, 30%. So if you see, your average return is 19. This average return, we'll be calling it as my standard return. Okay, are you getting? So these are the possibilities. Okay, and these possibilities are attached with probability. That means there is 5% chance the return will be 6%, 20% chance the return will be 12, 50% chance the return will be 20, 20% chance return will be 24, 5% chance return will be 30. So these are the probability. Okay, so this is the return. This is called as your average return standard. Now, if you calculate, next step is that to compute the risk. Next step is that we may have to compute the deviations. What are these deviations from the standard? Okay, you see, this is the standard, and this is what the possibility. So this possibility minus the standard. So 6 minus 19, we'll be getting minus 30. 12 minus 19, you'll be getting minus 7. 20 minus 9, you'll be getting 1. Okay, positive. So these are the deviations. When you talk about the risk, all kind of variance, whether positive variance or negative variance, both are risk. So there is nothing called as positive risk or negative risk. So this negative numbers needs to be converted to positive numbers because they are also risk. Positives are also risk. Negative numbers are also risk. So therefore, the deviations are squared here. This is D square. Okay, D square, you see, these are the same numbers are squared. Then they're multiplied with the probability into d square. We call it as PD square. PD square figures are appearing. Then we are taking total sum of PD square. This is 29.8. This is called as the variance. And the root over, if we take the square root of that thing, it will come to 5.46. This is what we call it as the risk. Okay, so this is just I wanted to give you some basic idea that how risk is computed. I repeat, risk is the variability of return or the possibility of deviation of return. So we are finding out what are the possible returns. These are the possible returns. We are also trying to calculate what are the probabilities of these possibilities. Then then you know the probability and we are taking the returns. Then if you know the return, we want to calculate what is the standard or average return. From average return, we compute the deviations. If deviations are there, we can compute the square of the deviations. Then that is multiplied with the probability. We get the PD square. The sum of PD square is computed here. Then we take the square root of that thing. We get a number that is called as the risk. This is one of the method of calculating the risk. Are you able to understand this? Hope you got some basic idea that how risk is computed. Try to understand it. This is another example. Now, there is a need to balance between the risk and return. Return, you have already understood. It may be periodic return or it may be capital appreciation. Then for how much of return, how much risk has to be taken. This exercise also we had done in our previous class. You had given reply that which project is to be selected, which project is to be rejected. Okay, now this is what in fact we had discussed. Of course, the risk calculation we had not discussed today purposefully, I told you, so that you'll be having some idea that risk is computed like this. Now, let us come to the next aspect. Next aspect is the goal or objective of financial management. If you look at your screen, you can find out 2 points are appearing. One is profit maximization. That means why you do business. One of the objective might be to maximize profit. And the second objective, if you see, it is talking about wealth maximization or value maximization. They are different things. One by one, let us discuss this concept. Okay. First of all, when you talk about financial management, people think the objective is to maximize the profit. That is understood as the main objective. But actually, that should not be. Why it should not be? There are various criticisms to the profit maximizing objective. First of all, you see, maximizing profit means if you say that you maximize the profit, there's a possibility that you will be unmindful of the consequences. That means कुछ भी हो जाए मेरे को प्रॉफिट बढ़ाना है. So क्या आप कर सकते हो? So you may think that you will increase the sales price. You may decide to reduce the quality in order to reduce the cost. Okay. So in the process, what will happen? You are unmindful of the consequences. You may lose your customers. And it's also not clear when you say to maximize profit, what does it mean? Do I mean that profit in absolute terms or in absolute amounts needs to be capitalized, or profit in terms of percentage needs to be capitalized and needs to be maximized? Which is to be maximized? That is also not clear. Okay, but one good thing is that when I talk about profit maximization, but I also mean that all the resources needs to be utilized efficiently. Then only profit can be maximized. Okay, and also this is an appropriate measure of firm's performance in the sense that you can compare the various firms or various companies by referring to their profit. If a firm is making good profit, that means what? It's doing good business. And it is also talked, it solves the interest of the society. Okay, right. How you may be thinking that a businessman is trying to maximize profit. What kind of service is providing to the society? Let's try to understand that he's trying to maximize the profit. He's trying to he's trying to maximize the use of resources. In the sense, he's trying to more efficiently use the resources. So this promotes the efficient utilization of resources. So these are the good things about profit maximization. But there are many criticisms to this subject. First of all, it is taught that profit is a vague concept. How? How profit is a vague concept? Because the computation of profit often depends upon the accounting principles, accounting assumptions, accounting estimations. So one accountant may compute profit in a way, another accountant may compute it in a different way. Right. So it is difficult to know what is that we are going to, what is that thing we are going to maximize. And when I saying that you are going to maximize profit, I'm also ignoring the timing of the return. Let us say one business is giving good return, more profit. Today, one business A is giving you, let us say, 20,000 profit. Business B is giving you, let us say, 25,000 profit. So normally you will see you'll go for business B because profit is more. But assume if the business B will give you 20,000, 25,000, but after 3 years, even if it is giving more profit, it is not giving early. So it is not that always we look after the profit. We also need to look at the timing of the return. Second, this profit maximization objective also ignores one more thing. That is about the risk. Suppose one business is giving you more profit, but risk is high. So your investors, so your stakeholders may not be interested to take that risk. Is it not? So try to maximize profit with high risk. So this is again one more objection to the profit maximization objective. It also assumes perfect competition. So I said earlier that profit maximization objective is good for the society also because society's resources are efficiently going to be utilized. But that's true only when there is perfect competition. If there is a monopoly, then one particular business may exploit the environment, may do harm for the society. And next objection is that it's a narrow objective. When you see that we are focusing on the profit, we are also ignoring the social responsibility of the business, popularly called as SRP. If you focus on the profit, then you may do bad things for the environment. You may like to do compromise in quality. You may forget your social responsibility. Therefore, it is not the good objective or the best objective. And in some situations, like a new business environment, the profit maximization is considered as unrealistic. It may not be possible practically. It may be difficult. It may be inappropriate, or it may be immoral also. All these possibilities are there. Therefore, people object. Although I showed you there are two objectives. One first objective is that profit maximization. Next is wealth maximization or value maximization. But now you've seen so many negative things about profit maximization. So now managers think that this should not be the main objective. So main objective you can call is the wealth maximization or value maximization. When I say wealth maximization or value maximization, what I exactly mean? I mean that the stakeholders' wealth should be maximized. Okay, stakeholders' wealth will be maximized when the market price of the shares gets maximized. That means here we are focusing on the long run. In long run, stakeholders should get some benefit. That will be possible only when the market price of shares gets maximized. Okay, right. Market price of the share will get maximized only when the investor feels that this particular company is going to give you more return. That means the future cash flows will be more. Okay, the present value of future cash flow is referred to as the net net wealth. Right. So this will say our fundamental objective. Fundamental objective is to maximize the market value of the shares so that stakeholders' wealth will be maximized. And little extension of that is the value maximization. Here we are talking about that we need to satisfy all the stakeholders so that in the eyes of the stakeholders, the company will be having a good image. And through that, you'll be able to maximize the wealth. Okay. So there are two concepts, in fact, profit maximization and wealth maximization. If you look at this chart, this picture, you can understand what are they. Profit maximization focuses on maximizing profit. Wealth maximization focuses on shareholders' wealth maximization, not profit. But share value, shareholders' wealth needs to maximize. Objective of profit maximization is profit. But here, the objective is to ensure that the market value of the shares is the highest. Profit can be easily calculated. You can establish a link between the financial decisions and the profit. Suppose you are taking a decision. आपने चलो एक मानो एक डिसीजन ले लिया, कॉस्ट कम कर दोगे, तो इसका मतलब प्रॉफिट बढ़ जाएगा. ये डायरेक्टली यू कैन एस्टैब्लिश ए लिंक. ओके, राइट. बट वेल्थ मैक्सिमाइजेशन के साथ डायरेक्ट लिंक एस्टैब्लिश करना मुश्किल है. सपोज यू आर रिड्यूसिंग द कॉस्ट, प्रॉफिट ठीक है, प्रॉफिट बढ़ जाएगी, लेकिन वेदर इट विल अफेक्ट द शेयर प्राइस और नॉट, नो वन नोस. So there is no clear relationship between your financial decision and the share price. That is the problem. What are the advantages of profit maximization objective? You see, these are the disadvantages of wealth maximization objective. Okay. So since there is no clear link, it may lead to management's anxiety and frustration. Managers may be frustrated because they are taking decisions, but those decisions are not getting reflected or the impact are not seen in the share price. Fine. Wealth maximization objective has got some objectives, some advantages. It emphasizes on long-term gain. It recognizes the risk and uncertainty. It also recognizes the timing of the return. It considers shareholders' return. Profit maximization objective does not emphasize on short term. It ignores risk, ignores timing, and it requires immediate resources to maximize profit. So this is the comparison between profit maximization and wealth maximization objective. Okay. Here is an example. You see, let's say project X, this project Y. These are the cash flows in different years. Project X is giving 50,000. Project Y is giving 55,000. So if profit maximization is the objective, we'll select project Y. But if you consider risk and timing, you can find out project X is more risky. Thus, project X is less risky. So one may select project X, and timing of the return also you can see. Project Y is giving high return in the last year. So one may consider project X also because risk is less and timing also good. So this is, you see, one example of the conflict of profit maximization and wealth maximization between them. Okay. Okay. So friends, I just gave you some idea about the objectives of financial. It can be to maximize profit. It can be to maximize the wealth. But I will suggest, if a question comes like this, the first objective you should treat is wealth maximization. Profit maximization can be treated as additional or ancillary objective, because without profit, it may be difficult to sustain the business. Wealth may not be maximized. We'll take a break here right now. We'll catch up again after 5 minutes. Thank you.